Okay, very good morning, everybody. Actually, Malaysia market, if you are on the spectator seat, it was very exciting over the last few days. But if you are technically on the ground, it is quite exhausting because on one side, there have been rumors and speculations that Parliament may dissolve, and then we may go into a general election, and what will happen to the budget and so on. But at last, yesterday, budget was announced. So I will walk through with you a little bit on our budget and what does that mean and what can we expect from the market perspective. Then after that, as my fellow colleagues, Paul and the rest has covered quite widely on the global environment, which Malaysia market is definitely not immune for. So I will only touch very lightly on that and then zoom into Malaysia market. Disclaimer is as usual. I think at the very beginning, Paul has already very comprehensively explained. The fact is our view is our view, never meant to be correct actually, because the market is moving so fast. Okay, now let's look at what has the government announced yesterday in our budget 2023. Now, as usual, when you look into it, we'll say that it's relatively a mild expansionary budget. But again, as usual, the government, because we'll say that probably maybe gearing towards election, so you can see that the emoluments, which is the pay to the civil servants, and the retirement charges, which both of them add up close to 1/3 of our budget expenditure account. And you can see that essentially the operating expenditure itself accounting for 73% of our budget, which is actually 3% more than the previous budget, whereas the development expenditure actually comes off. Of course, you have to take into consideration of the COVID fund, which definitely, touch wood, we hope and believe and would like to see that COVID is coming to an end, although there has been still some talks that there may be another variant coming in during the winter together with the influenza and so on. But touch wood, we hope that it is more towards influenza. And for that, I would say that the development expenditure is more or less the same. Now, the key issue that a lot of time market participants, especially foreign funds, are focusing at is that to fund our budget, 26% of them, or 27% technically, of the money has to come from borrowings, or the selling of the government assets technically is, but there's no announcement of whether there's any big IPO coming in this year yet. So that is always a concern from the foreign investor perspective, which I will explain to you later. Now, if you look into the government forecast, the GDP forecast, this year, everybody know because it's reopening with all the pent-up demand, so it's going to be strong. And government is looking at between 6.5 to 7. We are looking at around 6.8. Next year, government is looking at 4 to 5% of growth, where we are looking at the low end side of 4%. Now, the key part you can notice is that essentially the government still rely, in terms of the economic forecast, the driver will still come from the services sector. Services sector essentially, of course, mainly to a larger extent is their consumer spending. You can see essentially that the services sector, right, expect to have about 5% growth next year, which is still the strongest among the rest. If you look into details of the services sector, you can see that wholesale retail is still to expect to have a stronger growth. And then another one, of course, food and beverages also is expected to have a relatively strong growth as well. So these are the main that is driving. So put it another way, the economy or the driver is still come from the private consumption. So the next question is, can Malaysians spend? Or does Malaysian has the money to spend? The answer I would say to a certain extent is yes. But this yes, you have to be very careful is because it is a very polarized situation. So you have the lower income people who are still struggle to make the ends meet. Whereas on the other end of the spectrum, there's still plenty of money to spend. So that is where, if you look into it, the government, I would say, a little bit optimistic when you look into about up to the 5% growth, because no doubt that the rich people or the higher spectrum side of the Malaysian, they still have money to spend. But bearing in mind that next year onwards, like say, touch wood, we hope that COVID is to an end. At least this becomes part of influenza. Whether you need to jab every week, every year or not, we put aside. If that being the case, that means global traveling, right? Global tourism will be back to normal. So a lot of all these Malaysians probably will spend the money in overseas rather than in Malaysia. So that is the reason that we are a little bit on the conservative side, that yes, consumer spending will still be strong, but it may not be as strong as what the government has anticipated, despite, yes, government gives some tax cut, which actually, as usual, the tax cut, in terms of the percentage, the tax cut, the bracket seems good, but the actual amount that you benefit is not going to be that big throughout the year. Now, on the inflationary pressure side, government is looking at 3.3% next year, which we are kind of agree to it. Again, this is on the big assumption that the Ukraine-Russia situation and the OPEC plus, right, is flexible in adjusting the output, right? They have been talking about or they have decided to cut down the output, but this is sometimes a chicken and egg issue because if you forecast wrongly on the demand and you cut down the output, it will drive the price up and then it will cause inflation, which of course, ultimately it will go to a negative spiral into a weaker demand. So, and then if they want to raise the price, cut the output to maintain the price, then actually it will definitely tailspin the whole world economy. So this is still some uncertainty there. We hope that OPEC Plus are intelligent enough. At this moment, we kind of agree that with the current oil price, and if it's stable at the current level, inflation should be around 3.3%. So another one that everybody focus on, especially on the foreign investor, is definitely on the budget deficit, right? Of course, thanks to the surge in the oil price, which for 2022, originally government forecast was only $50 per barrel, and it turned out to be on average, we have not ended the 2022 yet, but it should be around $95 per barrel. That's why government have a really excess spending. The revenue increased by 22%. But the interesting part is that at the same time, the operating expenditure also increased. So it's very clear that government actually is preparing for election, right? I mean, you have to treat the civil servants well, which has already announced on the bonus and so on. So even because of a higher oil price, despite, right, the spending increased by 23%, which, I mean, from a certain perspective, is saying that the government does not know how to do financial planning. But essentially, because of the increase in oil revenue and of course, dividend from Petronas, 2022 estimated budget deficit is minus 5.8 or 5.8%, which is lower than 2021, which actually is, is a special surprise to the government. And government is looking at $90 per barrel for 2023. And assuming this being the case, essentially they still can maintain a budget deficit of 5.5%, which definitely is an accepted level from the foreign investor perspective, right? And of course, on and off, even 2 days ago, I think our internal Auditor General has saying that we cannot borrowing money forever, which is actually he's stating the trivial thing. But on the other hand, as a government, to a certain extent, you still can borrow, provided that you manage your budget or your fiscal deficit well. And at the same time, if most of the funding is come from Malaysia or come from domestic, which is like Malaysia, that is where I think to a certain extent at this moment, it's still not a big concern for the time being. Now, as I have mentioned, or rather to say, as what the government budget has shown, mainly, right, is still about close to 20% still rely on petroleum revenue. So what will derail the government budget, and of course to indirectly to the domestic consumption and so on, is essentially where the oil price level will be. That is the key part. And of course, that will also indirectly affect the direct tax income, because if economy slow down, your tax revenue will be reduced. But at this moment, like I say, we are not as optimistic as government, but we think that next year for 4.5% GDP growth is still very achievable. And again, this has always been mentioned, and there has been talk since last time. If some of you can remember, our minister Idris Jala, which talked about Malaysia can go bankrupt, you know, in around 2025. But if you look at this is as the government revenue, as a government revenue, essentially it's a tax income plus petroleum money. Essentially, the interest payment, it's not that good. It's not that good. The latest forecast for 2023 is 16.9. Of course, this is also due to the general environment of if government need to roll the bond over, they have to borrow at a higher interest cost, which ultimately will increase the interest payment as well. But all in all, I would say that it's still within the manageable level, right? It's not to say a super good report card, but I wouldn't say it's a F. So when we look at the budget, generally, we are kind of agree with the government general economic view. And the only positive on the budget is that government give out a lot of candies, like tax cut, a lot of quote-unquote free monies to encourage spending. So we will think that consumer spending, yes, but again, those who benefit from this tax cut and all this are not at the higher end of the spectrum. So that is unlikely able to 100% offset the spending where those higher income people, when they can't spend in overseas, they have no choice but to, enjoy their life in Malaysia. But once the economy reopen globally, some of this money will flow out, and it can be quite significant considering the current weaker ringgit situation. So, but taking all this into consideration, we'll say the budget is mildly expansionary. There are tax cuts, and then there is also a deduction of the stamp duty, which will encourage, right, and stimulate the currently weak housing market. Okay, so now with this in mind, government still somehow have to stimulate economy. And how is Malaysia in this global economic environment, especially looking into last quarter of this year and also into probably first quarter, because I think talking about longer, if I get it right, it's just by luck. I would say it's really by luck. Although, of course, we are not guessing the money. We have a model, but again, I mean, knowing that even IMF can revise the economy they forecast so many times in the year, so who are we to say that our forecast is that accurate? But looking into that, first, I think there's no dispute that by first quarter of next year, the US government will probably declare themselves in a recession, although now they are already in a technical recession. Now, the key is that one of the very high risk uncertainty which affect the oil price is how long this Ukraine-Russia war will sustain. And I would say that to a certain extent, of course, you can say it depends on Putin, but on the other way, you can also say that Russia can endure this war for quite some time. Because if you look into that, you can notice that despite all the sanctions, it has been since 2001, the light orange line on the left side, you can see that trade as a percent of GDP for Russia has been intentionally, I would say they have intentionally reduced their trade reliance, right? I mean, I have to say that they have already a plan to so-called Putin's Russia dream. China have the China dream, Russia has a Russia dream. So essentially, they have already intentionally reduced their reliance on the trade. So trade sanction, right? First, there are plenty of leakage, right? Other than the major developed countries. So even saying that with all these trade sanctions, it just doesn't really work for Russia to say that, okay, sorry, then I will stop the war and let's sit down. I need to let my economy to start roll again. No, this is not likely to happen. And if you look at the fiscal balance, right, they have been accumulating it thanks to the oil price, so they still can endure it. And as a foreign reserve, you can see despite of the war, right, the right side of the chart, you can see that it's still hovering at relatively high level. So put it another way, there's still leakage, they still can fund the war. So it's not like what Biden has been thinking that the sanction will cause Russia feel the pain. I would say Russian may feel the pain, but Russia as a country does not feel the pain. So they can still endure that, which is not a good news, because so long as there's a Ukraine-Russia war over there, it creates uncertainty on the wheat, on the commodities, both, I mean, the agriculture side and the energy side, which is definitely going to be a bumper for the, or a very bumpy road for the global economy. And similarly, if you look at China, okay, why I bring this China, later this afternoon, I mean, our colleague may talk about China. I mean, the whole key issue is technically China-Taiwan tension. Although we don't believe that this year China will unify. I mean, the political correct word for those from mainland China is unify Taiwan, right? From the other side of it is to conquer or occupy Taiwan or attack Taiwan, whichever you look at into it. But again, you can see that China has less reliant on trade, right? And even before Donald Trump era or Donald Trump time, and then the fiscal balance also is still relatively high. Of course, during the COVID time, every government has to go into the deficit. And same thing for a foreign reserve, is still hovering there. It's still high, although it has come off again for certain other factors where the fund has flow out. But again, if you look into this, you see similarity that should China, right, start a war with Taiwan, it can drag on. It can drag on. Let's say if it cannot unify within 1-2 months, right, it can endure the war. So these are the uncertainty that will create higher energy prices and higher commodity prices, which definitely is not that good for the global economy. But you look on the year-on-year change, of course, inflation pressure will definitely ease off. So I will skip China. I think our colleague will mention, and IMF is about to revise downwards of the forecast, so I wouldn't touch on this. Now, in terms of oil price, to a certain extent, one of the major reasons I would say that OPEC Plus decided to cut down production is also trying to maintain a so-called war premium on the oil price for whatever reason, because OPEC Plus, there's a Russia there. You can see that on the left side of your chart, you can see both the orange line and the blue line in the past technically has been almost no gap. But since the war, you can see that there is about a $10 per barrel of premium between WTI and the OPEC basket oil price. So what it means is that, like just now, my fellow colleague has mentioned that US itself is an oil-producing country, so they have the ability to so-called lower down the oil price a little bit. But OPEC has intentionally, I would say, maintaining a premium about $10. So in that context, the rest of the economy is not going to enjoy, a better oil price as long as, I would say, the Russia-Ukraine war continues. But of course, for Malaysia, that is a positive side because essentially we export our good quality oil at a better price and then import a low quality, cheaper oils for our own domestic consumption. That's why the government has all the money to spend in that context. Now, in terms of food, I think Paul has mentioned, so I would not go over on this part. Now, one thing that when we look into fourth quarter and also probably up to first quarter of next year, we have to bear in mind that when trend is coming down, it is not necessarily implying that economy is going into a weaker situation. It's more of the, if you look into the pent-up demand during the COVID period, and then after, initially when it come off, after that, the pent-up demand, and now we are actually back to the normal level. So what I'm trying to say is that whatever that is laughing all the ways to the bank during the COVID time, now they are experiencing a slower growth. In Malaysia context, the most typical example is actually our gloves company. And unfortunately, a lot of investors also stuck at the glove stock as well. But on the other hand, those who have been suffering during the COVID time, right, where because of the closure of the economy, right, such as tourism or even construction and all this, they are start coming back into the normal, right? So these are the things that when you look into the market, you look into investment, you have to bear this in mind. It doesn't mean that whatever high growth during the COVID time will continue. And also whatever sector that is totally dead during COVID, it will remain dead forever. So this one, I wouldn't touch so much. One thing is that we are still of the view that, again, because the world depends on how soon the US will start to slow down on its interest rate hike, right? But we are of the view that by end of this year, US inflation should pick up. Because if you look into it, if you break the inflation into two, which is the sticky part and the non-sticky part. The non-sticky is the volatile part, which is like the food-related, energy-related. It has already come off. But sticky one is still a little bit on the rise. But normally this one will be about 9 months after the non-sticky side coming off. So the peak of the non-sticky is in March this year. So we expect by December, the sticky part also will start to ease off. That probably will signal of result into Fed becomes a little bit more dovish, right? We hope so. So I wouldn't go on this part. Europe side, I think I can skip it. Okay, I think now I think that this one Paul has also mentioned, I mean, in terms of yield curve, which is on your left side, and in terms of whether the US go into recession or stagflation, right? I think recession, I think, is very likely, but we are still of the view that stagflation may not necessarily happening, because if you look at the right side, we have the so-called disaster index. It has started to rebound. So the sign of really going into stagflation actually is much less likely at this moment. So when we look into the global, I would say the US economy are still all right, although yes, it will go into a mild recession, but it's not something that need to be that worried of. Then China, it really depends on when they abolish or they stop the zero COVID policy, right? Then Europe, because of the Russia-Ukraine issue, the economy will continue to remain weak. So in this global environment, right, technically you can see that it's a little bit delayed. Even when there is a recession, it's unlikely to be a global recession, but it's more of Europe remain very weak, US a little bit mild, then China, if they stop the zero COVID strategy or policy, then I think you can see China start to come back. And in fact, you can see Japan also start to pick up. So in that context, I would say that even if the world go into a recession, it will be a relatively mild side. So what does that mean to Malaysia? Now, if you look at Malaysia, you can see that our manufacturing is still doing very strong, right? Our industrial index, production index, you can see it's still very strong on your left side, the light blue one. And export, just now Paul has mentioned, our E&E is still doing quite well, besides the petroleum. And palm oil for a while is spiked up because of good prices. And then tourism, we started to reopen the economy. It's still at a very low. It's still at very low, but definitely it start to gradually come back. So these are some positive factor that is supporting our Malaysia economy for this quarter, fourth quarter, and probably until first quarter of next year, right? Although consumer sentiment index, because of the inflation pressure, it has come off, but I would say that after this budget, the sentiment should rebound again. Like as what I say, consumers still continue to spend, right? The spending is still remain at a very high level, generally. So this is likely to continue. And spending and mobility, people has been start moving around to retail and recreation, you know. So all these are still has to start to be back to the pre-COVID level. So these are the positive part. Then there are a lot of questions on Malaysia household debt, right? Technically, one thing you need to notice is that okay, the latest number up to first half of 2022, the household debt as a percent of GDP has increased a little bit, up to slightly more than 90%. But on the other hand, if you look into the key part is the liquid financial asset. I mean, a lot of people just focus on household debt and saying that, oh, because of high household debt, therefore Malaysian cannot afford to spend or Malaysia is going to be in trouble. But on the other hand, people has forgotten to look at the liquid financial asset. When I say liquid, right, this is by definition by Bank Negara. So essentially, these are really can be converted to cash very fast. It's not your property, right? That you have finished your mortgage loan, or neither your EPF where you can't withdraw. These are really, I don't know whether it's how Bank Negara capture the number, if you believe it, it's but of course bank deposit is still very strong. And then I don't know whether they manage to capture those under the pillow one or in the Milo tin one. But essentially, yes, household debt is the latest is slightly more than 90%. But at the same time, yes, the liquid financial asset to a debt has dropped to about 130+%, but it's still a very healthy. Put it another way, that most of the Malaysian were not likely to be defaulted. Like I say again, this is on the other end of the spectrum. So I say it's a very divided. Those who try to make the ends meet one are still struggling, but those who have money still able to continue to spend. And the impact to the banking sector also is quite minimal, because impaired loans, right, it has go up a little bit, but it's still, less than 2%. So these are the positive factors for the Malaysia economy. And business confidence also start to improve. And then another one, as always been mentioned, is that especially of late, there are a lot of talks on 1MDB and so on and so forth. Okay, sorry, this is a little bit typo. Is it a typo? Yeah, I think it's a little bit typo here. It's a 2022 debt outstanding. Actually, we are about 83.5% of GDP, including the government guarantees, which include 1MDB. So, is it really that alarming? Definitely, as I say, it's not a beautiful number, but it's not that alarming yet at this moment. And if you look on the corporate basis, operating margin, right, for the first half of 2022, it was 7.3%, which is slightly coming off because of some of the cost pressure due to inflation. But the interest coverage is still very healthy at 7.1 times, and impaired loans to the bank is only 3%. So when you put all this in, it tells you that Malaysia economy are still relatively healthy. So the market shouldn't be that bad. And another issue always people will worry is that will we be the next Sri Lanka? My answer is no. At this moment, we are still all right. Because if you look at Sri Lanka, this is a sort of indicators we use to gauge the whether a country will be in trouble or not. If you look in Sri Lanka, you can see that if you look at some of this indicator, it's technically foreign reserve as a number of months for imports, and then short-term external debt versus export, and then foreign reserve to the short-term external debt, and then your broad money versus your foreign reserve and your short-term rate, and also your fiscal and current account as a percent of GDP, you can see that Sri Lanka has been consistently at least 4 out of 6 are in the red alert zone. Malaysia, like I say, we are not a super student, but so far we are okay lah. I mean, pass, but not with flying colors, right? So we are still all right in that context. So if the world, even US, does not go into stagflation, of course, Malaysia probability is even much lower. So in sum, like I say, we are more or less agree with a government forecast, right? Next year, we are looking at 4% GDP growth, CPI or inflation 3.3, fiscal. Well, I mean, we are not going to challenge government at this moment, so we follow the government 5.5% deficit, but we believe that there will be one more interest rate hike probably by end of this year, taking into consideration of yield curve has spiked up. And exchange rate, we expect ringgit to rebounded back next year at 4.32, which is still a long way to go. Like I say, if it happens to be like that, just happen to be lucky. Although we have a model, but this is something that, not an easy job to get the forecast right. But what we're trying to say is we expect ringgit to strengthen a little bit next year, right? Like I say, the yield curve has moved up. So that is the reason that why we think that there will be another 25 basis point hike by end of this year. So when we look into equity market, what does all this mean? US, we all know that it's still along the path of very, to a certain extent, very hawkish. And then the quantitative tightening is happening, is coming down. So that's why you see that commodities and also S&P 500 prices has come off to a certain extent, a reflection of lesser liquidity, I mean, fewer money in the market. And also, if you look at the margin trade in US, also is coming down. That's why these are the technical factors that cause the market to becomes a bit weak at this moment. Although, right, despite of the tightening, the liquidity are still there. I mean, it's not the dry up. So there is still some that can support the market. And we don't think that at this moment there's a financial crisis unless the Russia-Ukraine war really go into whether it is just a regional nuclear war or whatsoever. Unless that happens, otherwise, if we look at the financial stress indicator, almost all, whether emerging countries or US, are still relatively healthy, although it come off a little bit. So Malaysia market, like I say, no matter how, we are still partially affected by US. So when US come down, we can't run away from that. And we expect US market to be volatile until end of this year. So Malaysia market also putting aside of the uncertainty on our general election, which itself is causing market to volatile and towards a little bit weaker sentiment. So that is where our market is likely to behave. But we don't think that it's that bad. This one I think I can skip. So essentially, whether foreign funds will start coming back into our equity market is the key question. And in fact, you can see that on the right side of your chart, of late, there are some funds coming in. Although we attribute this partly is due to the China-Taiwan tension, where some of the money has been flowing out from Taiwan. Those money that flowing out from Taiwan, Malaysia also benefited some of it, although a big chunk of it go to Korea. So if you look into it, our foreign ownership is low. So once the foreigner come in, actually, we can expect market to perform relatively stronger. But it's just a question of when will the foreign fund come in, right? And then the next question, like I say, is election. If there is an election based on the last 4 election time, it indicates that the market can go up to, I mean, if election is going to be called within this year, the market can even go up to 1571. Which is actually 11.7% upside from the current level. It looks strong, but it's still possible because Malaysia, anything also is possible. But putting all this aside, our current base case scenario, until end of the year, we are looking at CI at 1541, right? 1,541 points. At a PE of 14.8 times, which is half a standard deviation below the average. Why we take it that is because there is still full of uncertainty globally. That's why we can't argue that, you know, the market will back to where it was as what in the average. Now, the worst case scenario, I mean, we are looking at 1,276, right? Why 1,276? This one just now, I think also it was mentioned by our fellow colleague that historically, since 2000, when there's a big correction in US during recession, it falls 45%. So we run linear regression on that. So that gives us where the market, if US fall by 45%, then our market will be at 1276. Again, we think that this is also not that likely scenario at this moment. So with this, what to invest in Malaysian market? I mean, in fact, if in terms of sector-wise, we are quite neutral for most of the sector, except construction, we are positive because, like I say, those that have suffered during COVID and with election round the corner, we don't know when, election round the corner, government, even in the budget, start talking back on the infrastructure projects and all this. So we are positive on the construction sector. And actually, we have some stock picks here, which we will share with you later. But one of the way we try to look for the companies is that we're looking for company with a good profit margin and also relatively efficiently use of asset, which is a high asset turnover ratio. And then, of course, the prior condition is a positive operating cash flow over the last 3 years, right? Another sector that we are a little bit positive is on the oil and gas, which just now also was mentioned. Essentially, I think globally, people are revaluing of under these GAFAs that for the oil and gas company, they have to revalue into, for investor, if you invest in oil and gas company, normally your emission is counted as your emission. This one, the formula may be rewritten probably by end of this year. And be with a relatively higher oil price now, we believe that oil and gas, like just now has been mentioned, CapEx will start to, not back to the good old days, but again, like say, compare when during the time bashed down by ESG, and then with the COVID, it start to see some turnaround situation. And then on the weak ringgit, that will definitely benefit our export side of it. So before I go into individual stocks, the risk that can derail our assumption base case scenario of 1541 by year end is of course global recession, abnormal weather that will cause a food inflation, China zero COVID policy that suddenly becomes strong again, geopolitical risk. Is essentially, I mean, it can be China, Taiwan, even North Korea also, you don't know what is happening. And then Russia, Ukraine, and then our domestic political uncertainty. We don't know when the election is called. Even after it's called, if it is a hang parliament, that definitely will affect the market sentiment as well. Sovereign downgrade, I think now is the risk is lower with the budget deficit as 5.8%. So stocks that we like. On the fundamental basis, we like Bermas Auto because it is in a niche market where those who can afford to buy, you know, are those who have the money to buy, right? It's basically, you know, it's like some of them are, it's like, you know, they don't want to let their children to drive to attract too much attention of driving Mercedes or BMW, then they ask then they buy Mazda car for the children and so on and so forth. So these are a very niche market and a very stabilized, and that's why we like Bermas Auto, and our target price is 2.45. Then Guan Chong, again, this is technically, I would say, irrelevant of Europe in recession or not, they will still consume chocolate, right? So Guan Chong is a quite good, well positioned there because actually it's a global in terms of a chocolate supplier. I mean, cocoa supplier, not chocolate, cocoa supplier. That's why we like it. And currently, our target price is 2.78. But beyond that, we think a lot will be still very short-term trading type that based on technical, I say for the sector that we like, which is construction, oil and gas, and part of the export. Example, one of the, on the technical basis, PECA, we look at the target price of 1.15. Essentially, it's a car seat upholstery manufacturer again. Auto industry is still relatively stable. right? And then UWC, target price 5.03. And then Hibiscus, target price 1.32. Gamuda, of course, we all know this is a famous, to a certain extent, it's a proxy to our construction sector. Target price 4.3. Kerjaya, target price 1.29. And then on the tech side, partially also on the exports related also is Inari. Although there are some, well, marketing as negative news, but it's just that iPhone 14 is the demand is still as what it is. It's just that it's not stronger. It doesn't grow stronger than what they have anticipated. So we think it's a good opportunity when the share price get bashed down that you look into, because I think again with this volatility, you know, market will be volatile the moment that people worry about rate hike, tech stock get bashed down. Then after, when the macro data shows that maybe Fed will start turn dovish, then the tech side will move up. So it's a bit trading type of stocks at this moment for Inari, and our target price is 3.105. Pentamaster, essentially because also auto related, which we think is still relatively all right, at least for this quarter until first quarter of next year. Target price 5.26. And then Dayang, target price 1.44. Essentially, this is well, I mean, okay lah. I mean, it's oil and gas related lah, and Delium as well. Okay, target price 0.84. Then, of course, for those who want to have some exposure through Malaysia on ETF, of course, you can go into like the Dow Jones ETF with target price of 1.93. And then for those who like to, actually depends on your view, right? You can also have the FANG. I mean, FANG for a while has been out of favor, and you think that it's going to be out of favor for a while. You can also look into the leverage side one, or even at the inverse ETF side. Okay. Another ETF is China. I mean, for those who want to have exposure on the China stocks rather than individual stocks, there's another one you can look into it. Okay. And also, I mean, this one is the FTSE China. This one is the Hang Seng China Enterprise Index. These are the things that you can look into it. And then, of course, you have ASEAN as well. And for those who need Sharia one, you have the Islamic, ASEAN Islamic. And I think time is about running out. So with this, thank you very much. Okay, why we pick UWC? Like I say, this is, we are looking at the short-term trading technical basis. Like I say, the market now is still a little bit volatile. We picked UWC not purely on the fundamental, although we go through the screening of operating margin is all right. Asset turnover is acceptable, and then relatively positive, strong cash flow, but it's still based on a technical perspective. What are the stocks will benefit from election? Well, first, of course, we know that it's construction sector will definitely benefit from that. That's the reason why we take up Gamuda on that. And then AirAsia and Capital A. Yes, with the opening of economy, they will start to benefit, but I think it will still take some time before we feel confident on this company, frankly speaking, because of the operating costs that they have been, suffering during the COVID time. Malaysia-Singapore exchange. We were, okay. It's quite a relative issue lah. I mean, like I say, we don't do a model on the actual rate between Malaysia and Singapore, but in terms of trend and direction wise, this year, I think Malaysia ringgit will remain weak against Sing dollar. But next year, like I say, generally it should be so-called trending up a little bit, just like together with the US dollar. And how do I manage exposure? I think you can talk to our Singapore team, the sales team. They will tell you how to manage it if you want to invest in Malaysia. Where do I see Maybank heading? Frankly speaking, once the interest rate environment stabilizes, we believe that Maybank is, as usual, foreigners start to come in, they are the proxy, and they should benefit from that. But I think at this moment, it's still too early to call for Maybank. What are the election stocks to investor focus in case of a hang parliament? If it's hang parliament, I think stay with cash first. Except for those companies that, you know, irrelevant of the political environment in Malaysia, like export-oriented stocks and all this. I mean, life was still going on. These are the stocks. Other than that, I think for like construction and all this, maybe you better stay away from it first. Yeah, of course. I mean, if ringgit continue to drop against Sing dollar, whatever you make from the capital gain will have to discount a little bit. And because dollar, I mean, currency volatility is move much faster than the stock volatility. So it's going to be very challenging. Yes, I would say so. But this happens if we have a hang parliament. I think the key is once election is over, and you see a clearer political environment, this is what we are looking at. That's why our base case scenario for next year, we think that ringgit will rebound back. Not to say strongly, but at least rebound back. D&O, we have not looked into yet, so we don't really have any comment at this moment. Hong Leong Bank also, we have not covered it yet, so we have no comment. Sorry for that. I think more or less I answer all the questions. Gaming and tourism sector. Gaming, we like Genting Malaysia. Magnum, we don't have a view at this moment. What do I think the outcome of the coming election will be? I mean, it is still highly speculative, but we think that UMNO will become the strongest party and win the most seat. Is Bursa a good stock to buy now? If you're looking at the more than 3 months or up to 6 months, yes, because once the political scenario stabilize and assuming that foreign funds start to come in, of course, Bursa will benefit from that. Okay, can we in Singapore buy IPO Malaysia? The answer, I think, is yes. Check with our Singapore colleague. Okay, Tenaga, you know that because of the inflationary pressure, right, the cost pass-through has been a very challenging for them. And then on top of that, because Tenaga is not really fully, so-called a favorite for the ESG investor as well. That's the reason why the stock has been relatively down for quite some time. Okay, I think I've answered all the questions. Or rather to say answer, I mean, some of them we don't cover, so we have no comment.